Imagine earning double-digit income from investments that barely flinch when the stock market swings. That's the promise of private credit mutual funds and ETFs, and also just regular private credit funds that have not been securitized. One of the fastest growing corners of the investment world right now. But are they really the secret weapon for modern portfolios, or just another Wall Street fad? In this video, I'm going to reveal what private credit mutual funds and ETFs actually are, how their returns and risks stack up against the S&P 500, and the 3 critical things you must know before adding them to your portfolio. If you're searching for higher income, lower volatility, and true diversification, you'll want to watch this all the way through. If you're looking for love in all the wrong places, you know the rest of that song. I'm Tommy Cloud. I am president of Third Act Retirement Planning. It's a company that I started by God's grace in 2000. We serve clients all over the country, people that have recently received a large sum of money and would like to navigate that with less stress and more wise stewardship. Let's start with the basics. Private credit is simply lending money to companies or projects outside the traditional banking system. Instead of buying public bonds, you're investing in loans that aren't traded on public markets. Think of it as being the bank of small and mid-sized businesses. How do you access this? There's mutual funds and interval funds. Pool your money with other investors to make these loans. There's also ETFs in this space, which often blend private credit with more liquid assets, or invest in publicly traded vehicles that hold private loans. The Cliffwater Enhanced Lending Fund, which is ticker symbol CELFX, is a prime example. It's an interval fund, meaning you can only redeem shares quarterly, and it invests across a wide range of private debt strategies, direct lending to real estate and even litigation finance. Now, as we look at private credit funds, we do need to understand that traditionally this world is just normal private credit funds, meaning they're not publicly traded like the mutual funds, the interval funds, and the ETFs. Those 3 are publicly traded and fall under the Investment Act of 1940, or what we call for short the 40 Act. But the old, like when we talk about private equity and private credit, typically those are funds that are not publicly traded and require you to be an accredited investor. So why is this a big deal? And both of these we use with our clients. We do have a track record of success with these. We haven't had a lot of disappointment with them so far, but anything could change. And that's why you diversify everything. Stocks could change, gold could change, real estate can change. Nobody's perfect. No investment is perfect. So because until recently, private credit was reserved really for big institutions. Now, with these funds, everyday investors can tap into this $2 trillion market. Did you know it was that big? Now, let's talk numbers, because performance is what matters. Over the past decade, private credit funds have delivered annualized returns in the high single digits to low double digits. And that's really what we've seen. The good ones that we have, that we work with, they typically don't perform much less than 8% a year. Of course, they do have bad years. They do have really good years, but on average, they're typically not going to go below 8% in the long run if they're a good one and well managed. As you look at the Cliffwater Direct Lending Index, that has averaged around 9.5% per year since 2004. And the newer one, the CELFX itself, has posted a net annualized return of over 13% since 2021 launch. I wouldn't expect 13% moving forward. I'm just telling you what it's done in the past. And as always, there are absolutely, positively no guarantees. Volatility is much lower than stocks, and that's an eyebrow raiser. We like that. The S&P 500 can swing wildly. Think 15 to 20% standard deviation. But private credit funds often see volatility as low as 1 to 5%, which is truly excellent. And often what you would categorize like a aggregate bond market ETF, that is that level of volatility. And the correlation, this is the most important thing along with the long-term performance. These 2 things are the 1-2 punch. it's typically between 0.1 and 0.4 with the S&P 500. 0.4 is getting into moderate correlation, but 0.1 is also getting into no correlation. So I would classify the ones that we use as having a low or very low correlation to the S&P 500. That means when stocks zig, private credit often zags, at least doesn't move in lockstep. This low correlation is gold for diversification. And true diversification is the way that the Yales and the Harvard endowment funds invest. It's the way that King Solomon, who had a net worth in today's dollars of about 2.1 trillion, indicated that he invested in Ecclesiastes 11:2. So if you believe that he wrote that, and I certainly do, adding private equity to a traditional stock and bond portfolio can smooth out returns and reduce overall risk. If you reduce overall downside in the long term, you can also reduce your returns because big drops, big losses impact the long-term performance of your portfolio more than anything else. If you lose 50%, you have to make 100% to get back to break even. If you lose 10%, you have to make 11% to get back to break even. But let's not sugarcoat it. There are real risks to private credit funds, private credit mutual funds, interval funds, and private credit ETFs. Number one is the liquidity. And I wouldn't necessarily call that a risk. Unlike regular mutual funds or ETFs, many private credit funds, especially interval funds like CELFX, only let you redeem shares quarterly, and sometimes only a portion of your investment. In a crisis, you can't just cash out instantly. That's pretty standard across the board. You got a lot with private equity funds as well. You can get out quarterly. I think maybe 5% a quarter. They want to limit it to that type of withdrawal. But again, when I think of risk, I think about losing money. And I don't think about not being able to get it exactly when you want it. Hopefully you can have some emergency funds set aside where you can invest in something like this to smooth out the returns of your portfolio. All this diversification that we have is to make it where we don't have to worry about our investments as much. And we don't have to go for long periods of time to get back to what we had. For the stock market, 2000 to 2013, that's a 13-year waiting period. Or for the stock market, 1966 to 1982. That's a long time. Or for gold is like 1980 to 2000, almost like 30 or 2006, something like that for gold, like 26 years for gold. It had to wait to get back to break even. So you really do want to remember the benefits of diversification. Diversification makes it where you don't have to wait as long to get back to break even. You might only have to wait 8 months, 10 months, maybe max 2 or 3 years if we have a really catastrophic event happen. At least that's what's happened historically. These funds lend to companies that can't always access traditional financing. That means higher yields, but also higher risk of default. While most loans are senior and secured, losses can happen. I would compare these private credit funds to like buying junk bonds, something like that. And the junk bond default rate, I think, is 1 or 2%, but some of these private credit funds have a lower default rate than 1%. So they really have done well. Because these loans aren't traded daily, fund managers use models and third-party appraisals to value them. In a downturn, these values can be marked down suddenly. The fees on these funds, you want to expect higher expense ratios, often 2% or more, because managing private loans is labor intensive. We're not just buying the U.S. aggregate bond index. The rules for these funds are evolving, and the rapid growth of private equity is drawing more scrutiny from regulators. So who are these funds for? They're definitely for income seekers. If you want higher yields in traditional bonds and dividend large cap stocks, certainly private credit will deliver that. It's for diversifiers, and that should be all of us. That should be every single one of us. If you're worried about stock market volatility, and you should be, the low correlation is a huge plus, as it is for gold. Gold and private credit are a fantastic way to have successful long-term investments, just like the stock market, but that perform different. Long-term investors, that's another person that will want to invest in this. If you don't need daily liquidity and you can handle some complexity, these funds can be a powerful addition. But if you need instant access to your money and you're uncomfortable with less transparency, think twice. Always read the fund's offering documents, understand the redemption terms, and know exactly what you're investing in. Not all private credit funds are created equal. This cannot be overstated. Mutual funds are not created equal. ETFs are not created equal. ETFs are more similar than mutual funds, and mutual funds are more similar than private credit funds. The more we get away from the low-cost indexing, the more different the funds become. Let's recap. Private credit mutual funds and ETFs open the door to high income and true diversification. And how could you not like true diversification? I keep beating this horse. I'm going to keep beating this horse. I'm going to beat this horse until there's nothing left of the horse. I have no intention to stop talking about true diversification. Number two, they've also shown strong returns, low volatility, and low correlation to the S&P 500. Beautiful, so beautiful. That's my favorite thing about them, is the long-term performance being really good and the low correlation to the U.S. stock market. That's a combination you can't beat because stocks are just so common. Real estate's common too. But they do come with unique risk as number three, especially around liquidity and credit quality. So I'd make sure you want to understand that as well. If you're ready to explore how private credit could fit into your portfolio, or if you want a personalized plan for sudden wealth, please click on the link and apply for a free planning session with me. I can talk to you about what you want to do, what we're doing with our clients, and what's worked for them and how that might work for you. Or go ahead and take our quick quiz to find out exactly how much you need to retire. That's in the link as well. We also have a whole host of resources that you can download, some e-booklets that might be helpful to you. Don't just chase returns. Build a smarter, more resilient and diversified portfolio. Thanks for watching, and we'll see you on the next video.